Good afternoon, everyone, and welcome to this afternoon's webinar, wherever you're joining us from in the world, on our new undergraduate economics courses. And my name's Joe, and from Westminster Business School, and I'm going to be moderating the session today. And I'm joined by the course leader for the new undergraduate economics courses. So there are two specialist courses, the Economics BSc Honours and the Financial Economics BSc Honours, and we're very excited to be launching those programs this year. And so the purpose of this talk today is to kind of give you the chance to meet your course leader before you arrive, and also to learn about how to go about applying and your study options. Now, the undergraduate economics program should be seen as two specializations within a broader degree, because there's a common thread to the degree. So there's a common first year, and then there's the flexibility to specialize and switch program. Now, the bulk of this talk today will be a guest lecture or masterclass on the topic of climate change. Because you really will address sort of key contemporary issues like this on the program. And Karen will give a brief talk examining the economic and financial costs of climate change with COP26, very much a topic in the headlines. And then after the talk's finished, we'll open up to a Q&A with you as our prospective students, so you can ask questions that you might have about the topic, just to kind of stimulate a debate. And as well as the topic itself, you can ask about studying at Westminster, how to apply, and the course itself. So yeah, it's over to you, Karen.
Okay, hello everybody. Good to see you. As Joe has already introduced, I'm the course leader, and I'd like to go straight into the topic of this talk, which is climate change, pay now or pay later. So let's go. Joe, are you able to? Brilliant, thank you. Okay, let's go. The next slide, please. Okay, so undisputably now, and backed up by science, is the fact that we are experiencing global warming. If you take a look at this chart, it really just shows you what we mean by climate change. So effectively, the chart is showing you the annual mean land temperature, and it's looking, basically what it's done is taken an average between 1951 and 1980, and then it's looked to see how much hotter it is actually getting, and what, how it's varied from 1800 up to current time. And you could see that basically from the 1950s onwards in particular, you could see that the average land temperature is just getting higher and higher. At the moment, they're saying that we're roughly about 1.1 or so degrees centigrade higher than sort of pre-industrial times. And this really is the issue. Now, of course, the key question is, is this a natural phenomenon, or is it a case of something that mankind is doing? So is it human driven? And the way to balance, I'm not a scientist, I'm an economist, but the way to balance is now that the science is saying that it is man-made. Just have the next slide, please. It's effectively because of our more intense use of hydrocarbons, so gas, electricity, coal-generated electricity, etc. The burning of hydrocarbons in order to grow, to use energy in order to grow and operate. So since industrialization, we are using energy much more intently. This chart from the BBC, again, is showing how high temperatures have been in current times. So this was looking at the high temperatures recorded in June 2021, so in the Northern Hemisphere summer period. And basically what it's basically showing you is that anywhere that you see sort of either blue or purple would be where the temperatures were below, and then so in a sense, so going towards record coldest, and then if it's white, it means it's near average. So temperatures in June 2021 would have been near average if it's coloured white. As you can see from the chart, it's predominantly pink to red. And red, everywhere where it's actually said red, means that in June 2021, they recorded the warmest temperatures. So again, you can see that it's very much a current thing. It's the temperature rise does seem to also be increasing. So let's go on and have a look and see what that actually kind of means for us as well. Okay, so this is where the link between the climate change and human action comes in. So as I had said earlier, we have, compared to pre-industrial times, we are using energy more intently, and primary energy involves the emission of what we call greenhouse gases. Now, these greenhouse gases tend to be measured in terms of carbon dioxide equivalents. It doesn't mean that every greenhouse gas is, or that greenhouse gases are only carbon dioxide, but they tend to measure it in that way. So our intense use of energy has meant that we are seeing more emissions of carbon dioxide or greenhouse gases going into the atmosphere. Now, this is a really interesting chart in that, in fact, it goes back 800,000 years before present time. And the point of this chart really is to actually make everybody aware that the carbon dioxide that we have currently in the atmosphere, which is seen as around the 400, or say, call it between 400 and 420 parts per million, that's generally the consensus in terms of where we are, is the highest that it has been. So if you look at how it's varied through various ice ages over time, you can see that where we are now presently, we've never had carbon dioxide emissions in the atmosphere as high as that. So the previous peak, it's shown in sort of mid of that graph there. It says the highest previous concentration was about 300 parts per million. And again, there we are, we're up at already 400. Okay, next slide, please. So that's us, that's you and I. So looking at the impact, so the science now says, yes, we've got, we have got global warming, and it does seem to be causing climate change. So in 2006, probably the most important review that was actually done to look at the economic impacts of climate change was the Stern Review. So it was done by a UK economist, Nicholas Stern, and he basically looked and tried to project the impact, the economic impact, the impact of climate change across 5 different areas. So he looked at food, water, ecosystems, extreme weather events, and the risk of abrupt and major irreversible changes. So if you look again at this chart, as you read it, you can kind of go across. So let's take the first one and look at food. So what he's then tried to do is he's tried to look at the impact based on how much higher global temperatures get above pre-industrial times. So as I said, we're already about 1.1 degrees centigrade, because of course there's carbon dioxide already in the atmosphere. We can't do anything at the moment about taking that out. So we're already factored into the fact that we've already got 1.1% centigrade rise. So if you just look at what it says about food, it says between sort of 1 and 2 centigrade, effectively there could be possible rises in temperature, in yield, for some high latitude regions. But as you get more and more temperature rising, it's more likely it's going to be falling crop yields in many areas, and in particular in developing countries. So you can kind of see that. Along the water, again, what you're seeing is a more intense climate change impact the further or the higher the temperature goes. So as you move to the right. So between 1 and 2 centigrades, in terms of looking at water, you see small mountain glaciers disappear, water supplies threatening several areas. Now, if you go to between 4 and 5 centigrades, so if you go far to the right, you see that sea level rises will be threatening major cities. So obviously much more of an impact. And so forth. So in terms of ecosystem, we already know we're seeing extensive damage to the coral reefs. And again, with higher temperature rises, you're going to have more and more species that will be facing extinction. The bottom there, the risk of abrupt and major irreversible changes, is that the higher the temperature gets above pre-industrial times, we're getting increasing risk of dangerous feedbacks and abrupt large-scale shifts in the climate system. And that really is an unknown that we don't know what that's actually going to look like. Okay, next slide. In terms of the impact on health, on people, the World Health Organization has published some key facts. Quite interestingly, they basically stated that climate change is the single biggest health threat facing humanity. And that is a direct quote from them. So climate change is going to affect across social, environmental determinants of health, because it impacts in terms of clean air, safe drinking water, sufficient food, and of course, secure shelter. So they've estimated that between 2030 and 2050, climate change is expected to cause approximately 250,000 additional deaths per year. That's from malnutrition, malaria, diarrhea, and heat stress. The direct damage costs to health, they've estimated to be in the region of 2 to 4 billion per year by 2030 as well. So yeah, again, that's a good website to go to if you're really interested in this area as well, and you can get some more information on the impact on health. But I just wanted to set the background there in terms of what do we mean? Because I'm sure you've heard a lot talked about climate change, but what is the real impact? And again, you can see it's across so many different spheres: the ecosystem, our lives, and later on in this talk, we'll go on to looking at the impact in terms of the financial costs, etc., and the threats to sustainability. Okay, let's go on. So again, another chart by the BBC that has highlighted the major cities that will be facing floods from just a 1 meter rise in sea level. And of course, again, with climate change, because it's so much unknown, we don't know how high sea levels could get, but we know that at extreme temperature rise, we will see cities gone. Okay, next slide. Also interesting from that chart, I don't want to go back, but just to say as well that it is across the globe. That's why this climate change is a global economic problem. Okay, so what does economics have to say about climate change? And yes, we can see it's an economic issue. We've got economic costs across the globe in terms of either mitigating, so doing something about addressing climate change, or facing, if you don't do anything about mitigating against climate change, then you're just going to get all this disruption and all this damage and all this potential loss of life and loss of species, etc., etc. But what does economics have to actually say about climate change, and how can that actually inform us and inform policymakers? So let's take a look at that now. Okay, so from the standpoint of economics, climate change is a result of a market failure. So it's a classic market failure. I wonder how many of you have actually done some economics before. So do we have anybody who's actually studied some economics that is with us at the moment? Maybe you could raise your hand if you have. No hands raised, so I'm going to assume. So I'm not going to go too deeply into the diagrams then, if I'm not speaking to an audience that maybe has come in touch with economics before. But I'm just going to give you an idea of the framework and the way we use economic analysis to inform real life problems. So climate change, as I said, is a global problem, and it's caused because there's a market failure. Well, what is the market failure that's occurring? Well, just so when we look at this diagram is showing us the demand and effectively supply for the production of, let's say, production of energy. So let's say this is heating demand. So the production of or generation of heat energy. So so you're at home, you've got your radiators on, it's cold, you want to be nice and warm, you're turning on your heating. Okay, so there's a demand. Now that demand, your demand for your heating, is going to be inversely related to price. So when prices are high, you'll demand less. So that's what we've got, that downward sloping demand curve. Now, again, here, MSB is basically saying that your demand is kind of an evaluation in terms of your marginal sort of social benefit of that heat. And here you've got also in this diagram an upward sloping supply curve, and in that case we've called this the marginal private cost. So effectively, the upward sloping line that you can see labeled MPC is the supply curve. So effectively, what we're saying there is that when if a company is producing something, it's always looking at it in terms of its costs. So that line will be equated with the cost of it producing that good. So production is effectively going to vary with price positively. So effectively what we're saying, at higher prices, producers will want to produce more. So you have that upward sloping. Now, the problem here in this market is that there is an externality. Effectively, the burning of hydrocarbons, so the use of energy, putting on your radiator, is effectively emitting greenhouse gases into the atmosphere. And we know that that's leading to climate change. So that's what we call the externality. We call that a third party, and that third party is the environment. The environment is being negatively affected by our private decisions to use heat, to generate heat, to warm our houses. So effectively in this case, well, if there was no externality, what you'd find is that the market would balance, where decisions made by you and I, the consumers, and decisions made by the producers to produce energy would come into balance, and they'd come into balance in what we call the equilibrium, which is where the two lines, the MPC and the demand curve, cross. So you'd have an equilibrium price, which is on this diagram is labeled as PM, and you'd have the amount of quantity is demanded, which would be QM. Now, I've already told you that there is an externality. Now, if it was possible for us to quantify all those costs, the costs associated with the food disruption, the ecosystem, the health costs of climate change, if there's a possibility to add that those external costs on, then we could get what we consider to be a more accurate supply curve. And that is what that second line to the left of the MPC, MSC, is the marginal social cost line. So effectively, what we're saying is a market failure has occurred because at the equilibrium PM, QM, only private costs are being evaluated. The producers are evaluating their private cost of production. And you and I as consumers are just evaluating our cost. How much does it cost? Can we afford to put our heating up higher or not? And the external costs, the greenhouse gases that are leading to global warming, that are then leading to climate change, are all being ignored. So the market is failing because we are in the wrong equilibrium. We're in an equilibrium that has ignored a whole load of costs. And those costs are very real because those costs have led to climate change. And we know it costs something because we've got data, we know, we can see what's actually happening to the environment. So, so this diagram then is saying that if it was possible to equate the cost of that heating in terms of what are the social costs, what are those external social costs that are not being considered when private decisions are being made. And if we could add those on, we would have a more efficient supply curve, MSC. And now, if you can see, that now interacts with the same demand curve, and that gives us a socially optimum quantity and price. And note two key things: QS, which is the new equilibrium, QS, PS, two things are significant. Firstly, QS is less than QM. So it means that in the original position, with the market is just left to its own devices and creates this market failure, too much is being consumed, QM is higher than QS. And then the other thing is that PS, the social optimum price, is higher than PM. So the market failure has occurred in two ways. Too much is being consumed to a lower price. The social optimum equilibrium would be PS, QS. Okay, so just take the next slide, and again, I'll briefly talk about this one. So there's a couple of things that are interesting. So I've highlighted here that the social optimum is QS, PS, and the market outcome, the market failure, and why we have climate change is because we normally veer towards PM, QM, because we are not taking into consideration any of these social costs. And hence that's the market failure. You can use taxes. So when you hear about taxes talked about, like, you know, should they tax? If you think of it, in the UK, about 70% of petrol price is taxes. Again, so you can, so when they talk about, maybe, so sometimes you may have heard in the media talk about environmental tax. That could be what they're trying to do is, you know, you put a tax on and effectively it's like moving us from that line that was MPC to the correct line, MSC. So adding a tax would effectively increase the cost of all that production and then move you closer to the social optimum. Of course, there'll be lots of questions like, well, what exactly is the right tax? What tax should they use? But anyway, let's not get too technical. Let's move on. So I hope that's kind of just set the scene in terms of theoretically the fact that economics sees climate change as a market failure. As a market failure, we're in the wrong equilibrium, where we're over-consuming these products that emit greenhouse gases, and we are consuming them at a too lower price. Okay, so let's take a look at what we are actually doing. So what actually is the world doing now? And as Joe had talked earlier, we did talk about COP26, and it being very topical now. So let's take a look and see what's being done. What are our leaders doing to address these issues? Okay, so the first thing to note is that in order to make progress, we must look at stabilizing the amount of CO2 emissions that are currently in the atmosphere. So this was thrown back from the Stern Review again, which I said was in 2006. And at the time, they had tried to look at the possibility of us trying to stabilize anything between 450 parts per million to 550 parts per million. If you can look at those lines, so the red bars, so it's a little bit of a tricky chart, but if you just look at the red bars, and those of you who've done some maths, if you look at those as almost like a 95% confidence interval. So basically, if you read the 450 parts per million, so this CO2 equivalence, what I mentioned earlier, that they kind of measure the greenhouse gases in terms of equivalence of carbon dioxide in the atmosphere. So let's say we were able to stabilize at 450 parts per million. What that line basically says, if you go to the far left of that bar of the red and where that dot is, and you go down, you get to the temperature, and it tells you what the eventual temperature change would be. So they're saying at 450 parts per million, you'll get anywhere between 1 degree centigrade all the way over to just below 4. Can you kind of see that interval there? So it's at the full length of the red bar. So, of course, a lot of variation there, but the idea from the Stern Review was that we need to get a point where we are no longer adding any more greenhouse gases. And basically that is effectively the political agenda. Okay, next slide. Of course, all of these things cost. So there's two things to bear in mind here, and this is what Stern basically drew to everybody's attention. So the quicker you adjust, the more cost it's going to be to consumers, to businesses, because they're going to have to adjust very quickly. And bear in mind that with all these adjustments, it's going to involve some technology. It's going to involve moving to renewable or possibly using more nuclear. There's going to definitely be technology-led development here. And there has to be much more development to obviously go to totally decarbonize the world, because we've been so used to using primary energy, using gas, using oil, using coal. So this chart now, this graph, so the brown line shows us what our projections would have to be like. What would global emissions need to look like going forward if we were going to stabilize at 450 parts per million? The first thing you should notice about that brown line is that we should have already peaked in terms of our emissions. And can you see that the line is coming down really sharply? Now, that would be huge cost to business. So that's why it then came like, okay, so maybe stabilizing at 450 parts per million to 500 parts per million. So if you look at the red line, would be a little bit, that just gives a bit more adjustment. That gives time for technological change, for technology to actually generate renewable energy at, what should I call it, at a price that is acceptable to the market, that people can actually engage with it. So that's one of the things from this chart, is to show you that change is going to cost. If you do it quickly and you want to stabilize at a low rate, that means action has to be very swift and adjustment has to be very swift, which means it will cost. There will be high cost with that. The other thing, which is what's written on the right there, is that bear in mind that delay will cost, because what happens is if you delay changing, you are still investing in old technologies that are going to emit greenhouse gases. So there's a cost also in delay. So lots of issues. It's not easy being a policymaker right now. Okay, next chart. Okay, so another very significant, well, should I say, a very significant moment was COP21, which was the Paris Agreement in 2015. And this is where all parties effectively signed up to limit the change in temperature to well below 2 degrees centigrade. So that was the political commitment. And in effect, what they've actually said was that there should be efforts to achieve 1.5 degrees centigrade, so no more than that, but at least to keep it well below 2. It also aimed to increase the ability of countries to deal with the impact of climate change, which is really important, especially for developing countries, because the consensus is that developing countries are going to be more adversely affected by climate change. And they also committed to mobilizing finance in order to basically move to a low emissions environment. Okay, next, so that was the Paris Agreement. Bear in mind that the Paris Agreement is totally voluntary. So these are, and this was done as a country base, so countries are basically signing up. Currently 193 out of the 197 countries have ratified the agreement. It came into force in 2016, so although it's called Paris Agreement 2015, it didn't come into force until World Earth Day on the 4th of November 2016, because they have this sort of double threshold. Effectively, at least 55 countries need to sign up, and they must represent at least 55% of global emissions. If you think about it, that's just to make sure that the agreement actually has some power. If not enough people, countries have signed up, then it doesn't have that same political strength. Okay, so let's move on to the next one. COP26, which just happened, so you must have heard quite a bit about that. And again, coming out of that, it was very, well, you'd have to decide whether you think it was very positive. So I'm going to tell you in a neutral way what came out from COP26. But I think there's a lot of views in terms of its success. So let's go. Okay, so the Glasgow Climate Pact was agreed. So there was a new agreement. That was really positive because of the fact that it effectively revisited the emissions cut and recommitted the world to try to aim for the 1.5. So before, Paris Agreement was no more than 2, or at least below 2, and possibly trying for 1.5. This kind of secured the 1.5. And then what was really notable about it was the very first time that coal was singled out and called out, and they actually made a commitment to limit coal use. In the last parts of this climate pact, it got watered down a little bit, but coal was singled out. Of course, the coal industry were not very happy about it. I know coal has made, there's a lot of things called new coal technology, where coal has really tried to clean up its act in terms of the environment. Coal was typically seen as the dirtiest out of the primary hydrocarbons. So it would be coal and then next oil, and then gas was seen as the cleanest. But coal has been targeted because, again, it does have that reputation as being the dirtiest of the hydrocarbons. It is responsible for 40% of annual CO2 emissions. And to meet Paris Agreement goal for global emissions, the global emissions need to be reduced by 45% by 2030 and nearly zero by mid-century. So it is quite a huge commitment. Another thing that came out from the deal was increased financial help for developing countries. So let's go on to a little bit maybe about the views and what people felt about the Paris. Yeah. Okay, so we're going to talk about the views now. Next thing. So I'm going to start off with the developing countries. And generally, I think you could kind of sum it up with they were not very happy. So I've got a couple of quotes. So this was from, the first one's from Shauna Aminaf, who was environmental minister for low-lying Maldives. So again, you've got the scene set there in terms of, you know, the impact in terms of their threats in terms of rising sea levels. So Shauna said, we have 98 months to halve global emissions. The difference between 1.5 and 2 degrees is a death sentence for us. Mohammed Adu, who's director of a Nairobi-based think tank, Power Shift Africa. So in effect, Mr. Adu was talking on behalf in terms of the African view. And he said, the needs of the world's vulnerable people, have been sacrificed on the altar of the rich world's selfishness. The outcome here reflects a COP held in the rich world, and the outcome contains the priorities of the rich world. Again, now from Antigua, so Antigua and Barbuda, Leah Nicholson, who basically, again, this was trying to get the small island state view. So Leah is the chair of a 37-strong alliance of small island states, said, on pleas for loss and damage, we are extremely disappointed. Greenpeace, it's meek, it's weak, and the 1.5 goal, a centigrade goal, is only just alive. But a signal has been sent that the era of coal is ending, and that matters. So that was the views. If we go on, we could go a little bit deeper into some of the thinking behind that, behind those views. Okay, so this was a report that was published in Time magazine, and it highlighted the 6 places in the world that were especially vulnerable to the impact of climate change. So effectively, in this report, and the report basically reflects the research by several different sources that basically have said that it is developing countries, places that have widespread poverty, and countries with ineffective governments that are going to be worst hit by climate change. Even in terms of, you look at it from an income standpoint, in terms of, their average GDP per capita being low, or ineffective governments, or just the fact that the infrastructure is just not going to be in, to the standard that is going to be able to withstand climate change. But on several different spheres, it's likely to be hitting those least able to actually deal with climate change. So I've got another quote here from Niall Smith from Maplecroft. It said, "The places with the least level of economic development are certainly in line to feel the impacts with the greatest degree, partially just due to their geographic fate or their location, but more so based on the socio-economic and governance factors." So it's against that backdrop that those views, the various views that we saw from the developing countries on the previous slide, really have come to life. Next one. Another interesting idea around is that is this idea of producers pay principle, because you could ask yourself, okay, so the developing countries are not quite happy with what's going on with the political will, but at the same time, you've got it is going to impact them harder. But then you could be asking yourself the question of like, well, whose fault is this? Well, originally I said it's a global problem, so it's everybody. But of course, some countries have had a bigger impact in the sense of their carbon footprint is bigger. So I mean by that, they've actually emitted more. So this chart from Carbon Brief just shows you on a cumulative basis from 1850 to 2021, the impact on a country by country basis in terms of cumulative emissions. So the top two there is the US, China, then followed by Russia and Brazil. So there has been this debate, this long-standing debate about who should do more and who should pay for climate change. It is recognized that it's a global problem, but the developing countries have been saying that they've still got things like the Sustainable Development Goals to address. They're still fighting things such as hunger and malnutrition. And the more wealthier countries should be taking the lead. And that has been the kind of historical. What has been thrown back at them has been the fact that, well, from a historical basis, it may be true that the stock of emissions that are in the atmosphere now are mainly from the current rich or developed world, but certainly because a number of developing countries are industrializing now, the flow is coming more from developing countries. So again, there's been that back and forth. And luckily for things like the Paris Agreement and now, the Glasgow Climate Pact, they are coming together to try and find a joint solution. But there has been this sort of tete-a-tete between the developing countries and developed countries. So I think we're now going to go on to see the US view. I believe, yeah. So the US has had a bit of a checkered past in terms of its involvement, especially with sort of on a political stage in terms of agreement. So before the Paris Agreement, there was the Kyoto Protocol, which the US had withdrawn from as well, which was another effort, another global effort where countries were trying to put things in place in the short term to try and reduce emissions. So historically, the US has never been really in favor of things of interventions such as, taxing. I mentioned earlier that, if you wanted to move from our market failure equilibrium to the more optimum equilibrium, you could use taxes. So, but the US has been very anti those. But generally what it's been with them is that they have felt that if the US or EU or the developed countries put extra costs on their businesses by addressing climate change, and countries such as Indonesia or China or Brazil aren't, it means that they will be losing competitive advantage. So they'll be thinking that they saw it as this is an extra cost for our businesses, and then countries such as China or Vietnam or Brazil can get a competitive advantage because they're not having to meet the cost now of addressing and mitigating against climate change. It has been true to say, though, that they have always been in favor of what we call long-term investment in technologies, because they think ultimately the long-term solution is that we need more renewable that's definitely true, but what do we do in the short term? Because we can't really wait until all those technologies are up and running at the correct cost, because obviously it starts on quite high cost and then it starts to come down as more and more people use it. You do need to take some form of intermediate sort of short-term plans, such as putting taxes to try and deter people. Okay, so talking in terms of the Paris Agreement, Donald Trump did actually pull out of in 2017. He pulled out of the Paris Agreement. Same arguments. He said it was a bad deal for the US economy, but he rejoined in February, or the US, I should say, rejoined, because that time it wasn't him, but he rejoined in Biden rejoined the Paris Agreement in February this year. Okay, so pretty much coming to the last section now. Joe, we still doing okay for time?
Yeah, so if we, do you think you can, so we've got about 20 more minutes, so
okay.
How long do you need for the talk?
I'll probably go on, look at a couple of bits of data now for no more than sort of 5 minutes or so. And
that should be fine. Okay.
Let's just take a quick look at what is the role of the financial sector, because I just think this is quite interesting and will be particularly interesting to those of you interested in financial economics. So let's take a look. Okay, so this financial sector has to be absolutely key in terms of us meeting the Paris Agreement and the Climate Act of the Glasgow Climate Act of 2021, because clearly we need to mobilize financial resources. The UNEP in 2018 estimated that for full decarbonisation, the world needs something of the order of between $5 and $7 trillion US dollars per year. So clearly the financial sector role is going to be key in terms of mobilising those resources. And of course, the financial sector is going to be key in terms of the efficient allocation of resources. Because if you think about it, and when I say resources, efficient allocation of capital, because if capital keeps going into non-climate changing environment, or i.e. continues to support industries that are generating greenhouse gases, then we're never going to meet the Paris Agreement. So we need the financial resources to be efficiently allocated into energy sources that are green. Okay, next one. Next slide, please. Okay, so what does that really mean? Well, it means that we need to get investors, asset managers, financial service providers, and policymakers to redirect financial flows towards the expansion of renewable energies, and that needs to be done swiftly. We also need to make sure that that the decision-making process is also climate compatible. So that's going to also need coordination on the political stage between finance and environmental ministers. And we also need a coordination between financial supervisors and the regulatory bodies as well. And we need the right types of financial incentives. In order to respond, if we want to change behavior, the financial incentives need to be there. So one of the ones that that's been used has been carbon pricing. I don't want to get into it too much because we just literally don't have much enough time to talk about it, but effectively the right signals. So if companies are doing the right thing, they need to be rewarded financially. And if companies aren't doing the right thing, they need to also be penalized. That needs to cost. So one way of doing that has been this idea of getting a price for carbon. So by carbon, we mean by the emissions. So if you've got low emissions, then you should be rewarded. And if your emissions are high, you should have to basically pay the true cost of your operation. And that's what they really mean by carbon pricing. It's a little bit more complicated than that, but I've tried to make it simpler. Let's take the next slide. So in terms of the financial sector, it itself has vested interest in getting things right. There are two main risks that they will be facing. First one is the physical risk, and that is the fact that frequent climate change, extreme weather events will basically erode the value of financial assets and will also increase liabilities. If you just think about it, if we're going to get more and more extreme weather and climate change is going to impact, that means that could be damage not only to lives, but to the security of our homes, just the whole, I mean, if a city floods, that's the whole of that financial assets, all the buildings, the bridges that gone, the roads, it's huge. And they're also transitional risks. So transitional risks are related to the process of adjusting to now a new low carbon world. So there could be shifting policies that change how financial assets, for example, if you're right now, if you're a coal company, you know, this transitionary stage is going to have an impact on you. So that's going to change your financial, that may change your ability to pay for your debts. So there is transitional risks as well. Next slide. I did promise 5 minutes. I'm going to speed it up. Okay, so in terms of the physical risks, so you've got an acceleration in the progression of climate change and in the manifestation of physical risk could have what we call a destabilizing effect on the financial system. And I think you could kind of think of a number of ways that could materialize. If you just think about particular islands, look at what the quote from the person from the Maldives. If you're particularly low lying, it could mean that you just don't even get any insurance. You don't have any insurance at all. So increased physical risk could result in both what we call market risk and credit risk to the financial system. Insurance and underwriting risk. So again, more frequent storms and severe storms is going to lead to more underwriting risk, and you get higher than expected claims and you know, insurance risk again, and more physical risk associated with that. There's a couple of charts that just show you to follow, that just show you what that could actually look like. So this chart shows you the impact of physical risk on the global economy and how it has increased. So this to the left panel shows you the number of natural loss events. And then you can basically see that those have been increasing over time. And on the right panel, again, tries to gives you an estimation of the global economic loss just from natural catastrophes. And again, you can see they've coupled it in sort of decades, so the 80s, the 90s, 2000, and then 2010 to 2019, and you can just see how much more, how much higher the costs. In this case, the left-hand slide showed you the number, but the right-hand slide shows you the cost. So that is again where you're getting the physical risks that will be impacting on the financial sector. Next one, I think we should be nearly there. And this is just now specifically economic loss resulting from weather-related catastrophes, and again showing you how much they've increased. And next one, I think we're at the end. Yep. So, any questions at all? Thank you very much for listening.
Yeah, thank you, Karen, for that wonderful and very informative talk. So yeah, thank you for everyone who's joined the session today. We'd like to invite you to post your questions in the Q&A box and any comments in the chat box. Now, your question can be about the topic under discussion, or it can be about studying on the new economics courses. So yeah, we'd invite you to come forward with your questions, and yeah, we'd be grateful for your participation. If I can start with a question to Karen, this was a taster lecture in effect on the economic costs of climate change. What I'd ask is, how are such issues as climate change, Brexit, and also the financial and economic consequences of, say, the coronavirus pandemic addressed on the two BSc courses?
Okay, well, really interesting question. Thanks for that question, Joe. So in terms of your first year, you'd have a common first year where you'd be looking at macroeconomics and you'll be looking at microeconomics. Macro is about big issues like growth, unemployment, inflation, etc. So it's going to be impossible to really do a macroeconomic course without looking at COVID. So COVID, the impact of COVID will be addressed straight into your first year. I mean, economics is very current. You know that we will always be updating the material and bringing real life examples. So we have a history. You know, back to Adam Smith, we've got 100 years of history in terms of economics as a discipline. And we'll be applying the theories, but it is an evolving space. If we consider things like the global financial crisis, that changed the way we thought about economics as well. So things always change. It's an evolving discipline. So you would get that, it would be linked into your modules. Again, I should have said the degrees module are made up of modules. So you have your micro, you'll have your macro, you'll have your quants to support your decision making and your decision techniques. That's what the numerical modules give you. This topic that I've picked out in terms of climate change is specifically addressed in an option module that I'm a module leader for, which is called Global Economic Issues, where we specifically look at global economic issues. So we look at climate change, we've looked at the global financial crisis, we look at issues like migration, trade. Brexit obviously came up in there, and that's a second year option module. So again, it will depend. Also sometimes, and students do often ask me that, is that you may find that you may look at COVID for one module and you may look at it again in another module, but you might be looking at it in a slightly different way and from a different angle as well. So you could have been doing something in terms of business and you may be specifically looking at the impact on hospitality, as opposed, which would be totally different than looking at COVID in terms of the impact on the global economy or the impact on national economy, on debt. So it's really, I mean, something like COVID could cover so many, so you could look at it from many different angles.
Yeah, it sounds very like interdisciplinary, and looking at the macro and the micro, and also, as you just saw from your talk there, you looked at the finance and the economics of it, but also the climate science, the social and public health impact, the global politics of it as well, which we saw. So yeah, it's really taught in an interdisciplinary way.
Yeah, so for example, with development economics, we'd spend a lot of time looking in terms of, say, maybe like the Sustainable Development Goals, how development can adjust to that, and also looking at, the Paris Agreement and their views, because it's a very different reality. So it really does depend on the stakeholder as well, and different modules will emphasize that in different ways.
Yeah, very much so. And it's a very flexible course, and there's some scope for specialization in your choice of option modules, and also students, because they're studying it's a common thread the first year for both programs. So students have the option to switch as well as to specialize. Is that right?
Yeah, I'll just explain that in terms of the first year. So the first year, there are some common core modules: macro, micro, macro, and then you've got your maths for economists. And then you have another core module depending on which degree you're on. So if you're on BSc Economics, you do Crisis and Controversies in Economics, which looks at economic history and how the economic thought has developed. But if you are on Financial Economics, you do a module called Introduction to Financial Economics. That's where you, and it's a great module because you've got Bloomberg, you're going to get to use the Bloomberg suite, which is what traders use. So you'll get a certificate of completion for that. And it's also got a built-in virtual internship with Fidelity International. So that's really exciting as well. So you're getting really practical. You get to use your financial techniques in a practical sense, working for a company virtually. So those are the two cores that are different, But however, to keep the flexibility, any one of those modules can be taken as your final option module. So the degrees all have an option module. So if you're on financial economics, then you have to do Introduction to Economics plus the other modules I talked about. But if you chose the crisis and controversies for economics, then that means you've covered all the core that the BSc economics had. So that means you could switch in your second year, and vice versa. So the BSc economics students, if they've taken their five core modules, and then for their option module, if they take Introduction to Financial Economics, that means they could switch to financial economics in the second year.
That's great.
And that's the way we've done it. We've left that window of opportunity.
Yeah, it's
of course, there's lots of options to choose from. That's the other thing we have. So you could take language modules as your option module. So if you're sure the degree you're on, you could decide to study a language alongside that as your option module, or you could take any module within the business school. And of course, we're a large business school, so we've got modules in entrepreneurship, marketing. Some of my students did coding, which they found really interesting. Wow. Obviously very useful now. So there's so much to choose from. Human resource management, you can name it. So there's lots of options. And just to say one thing about the final year as well, we've responded to our current students who've told us they wanted more options in their final year. So it's your final year that you could really tailor. There's only 2 core modules, and then you could tailor and pick the options that you really want to study to set you up for what you plan to do post-graduation.
And also, yeah, so thanks for explaining the courses and the study options. In terms of the way students are assessed, we're moving away from the very exam-based assessment methods to giving students more autonomy and choice over authentic assessment methods. Now, how does that work in terms of how students will be assessed, and what different options can they consider for their...
I think we've been so creative in terms of the assessments, and our emphasis is on authentic assessments. What we mean authentic means it would work in the real world. So I'm here now, I'm presenting. So that's the kind of, so you may have to present your views. One thing that employers have always told us is they would like to see graduates able to present technical economic issues to non-economists. So using simple language. So that will be the kind of thing you'll be asked to do. And we've got a variety. You might have to write a report, which can happen in the workplace. You may have to create a podcast. You may have to create a research poster. So we've got a variety of different authentic assessments, and things like the virtual internship is great because you, again, will be working on a real life problem that a business is facing, and you'll get to apply the theories that you have learned in the course into that piece of work.
That's excellent.
Keep it authentic, things that you would actually, so it's preparing you for working life.
Thank you, Karen. So I'll just leave the floor open for members of our audience to post their questions. If there aren't any further questions, we might draw matters to a close. So what would you say, what final words of motivation would you give, Karen, to students who are considering to study economics at Westminster Business School and thinking about studying in London?
Okay, well, I would say 100% it is the most interesting time to be studying economics. Economics has something to say on everything that is on the top of the political agenda right now. I mean, I love economics. I'm an economist, but I just think it's getting more and more exciting. We've got so much to contribute, and you could be right at the forefront of policy making or helping a small SME to make the best decisions and ensure their sustainability. But it's addressing all the key issues. And why not London? London is the financial centre of the world. We are located right in the middle of London. We're NW1 postcode, opposite Madame Tussauds. We are in a key location. And not only is it great to just be in the centre of London, it's great because so many businesses and industry and banks can just easily come to visit us, and we get lots of guest speakers. So that gives you time to network, opportunity to network, and actually be in a place where it really is happening.
Lovely. Thank you, Karen. And yeah, and if you want to, I'm sure Karen would be, very, very pleased to hear from you if you wanted to continue this conversation and answer any questions that you might have, ask any questions that you might have to Karen via email. And for any general inquiries that you have about the course and how to apply, please contact the course inquiries team. And so thank you for your interest in studying at the University of Westminster from Westminster Business School. You can visit the link to our landing page below. And yeah, we look forward to you joining us next September on the inaugural intake of the BSc Economics and the BSc Financial Economics. So, and thank you today, Karen, for your time and for such an excellent presentation.
You're welcome. Thanks, Joe.
Thank you.
Thanks,
Bye
everybody.
now.
Good luck with your studies.
Thank you. Bye, everyone.